Last month, a family in Florida opened their escrow statement and realized their monthly payment hadn't gone up because of rates or taxes or even repairs. It went up because their insurance doubled. No warning, no negotiation, just a letter saying, hey, pay this or lose your coverage. And that's when it hit them. They didn't suddenly own a more expensive home. They were just carrying a more expensive system. This is happening quietly everywhere across the United States. And it's breaking the house market in a way almost no one is talking about. Because if you own a home, you already feel this. And if you rent, you're about to. Because if you're trying to buy, this is the wall you keep running into without knowing why. And here's the contradiction no one wants to explain. Housing prices are supposedly stable. Mortgage rates haven't moved up or down too much one way or another, but monthly housing costs are still climbing. Not because of the market, because of insurance. Homeowners are getting squeezed first, but renters, they're next. And the pressure is spreading faster than wages, faster than rents, and faster than any relief that's coming. And this wasn't an accident. And it wasn't temporary. This was engineered. Because for decades, we were told the cost of owning a home was simple. Mortgage, taxes, maintenance, and insurance was kind of a background noise, a checkbox, a rounding error, so to speak. Now it's a weapon. In some states, insurance premiums are rising 20, 30, even 50% in a single year. Coverage is being pulled altogether in some cases. Policies are being rewritten with exclusions so broad, they're practically fiction. And homeowners are discovering something really terrifying. You don't fully own your home if you can't insure it. And this is the part that economists don't say out loud. The housing market isn't just about prices anymore. It's about whether homes are carryable. Because the real cost of housing isn't the purchase price itself. It's the monthly burn rate that accompanies it. Insurance shocks don't show up on Zillow. They don't appear in a CPI index. They don't trend on real estate TikTok. But they hit your bank account like a freight train. And here's why this matters more than rates. A rate spike hurts buyers, sure, right? An insurance spike hurts everyone already inside the system. So try to think of it like this, right? Mortgage rates are the front door. Insurance is the oxygen. You can survive a bad entry price, but you can't survive suffocation. And this is where the hidden homeowner squeeze begins. Insurance companies aren't just reacting to storms or fires. They're reacting to math, climate risks, reinsurance costs, capital requirements, litigation exposure. So they're going to do what the system rewards them for doing. Raising prices, reducing coverage, leaving markets. But the cost, man, it just does not disappear. It just gets passed down. Homeowners absorb it first, then landlords, then renters, then entire neighborhoods. Every 90 seconds, we all have to try to remember this. Institutions adjust, households absorb. When insurance rises, landlords don't eat the cost. They push it into the rent. And when insurance becomes unavailable, buyers, they just disappear. Prices stall, liquidity dries up, and when liquidity dries up, the market doesn't crash loudly, it fractures quietly. And this is the twist most people miss. Everyone is watching rates. No one is watching the actual carrying costs. But carrying costs decide survival. A homeowner doesn't default because their house lost value. They default because they can't keep paying to hold on to it. Now, insurance shocks turn stable homeowners into fragile ones overnight. And that's why this isn't just a homeowner problem. It's a systemic one. Banks require insurance. No insurance, no mortgage. No mortgage, forced sale. So When insurers pull back, banks tighten. When banks tighten, buyers vanish. When buyers vanish, prices freeze, then slip, but not necessarily crash, right? Just slip, like a glacier melting from the bottom. And this is why markets like Florida, California, Texas, and parts of the Southwest are sending like strange signals. Homes sitting longer, price cuts that don't attract buyers, listings relisted again and again. It's not demand weakness, it's affordability erosion. So think of it like this, right? Because nobody wants to kind of use these type of analogies, especially in housing, but this market's like a car that still looks great, but the cost of the gas doubles every month. At some point, it doesn't matter how nice the car is. You stop driving it. And that's what homeowners are doing right now. They're cutting repairs, delaying maintenance, skipping upgrades, which creates the next problem. Deferred maintenance lowers long-term value. Lower value increases lender risk. Higher risk increases costs. And the loop, it just tightens. This isn't a market, it's a machine. And insurance is the pressure valve no one designed for failure. And here's the thing, housing didn't become unaffordable because prices went up. It became unaffordable because carrying a home became unstable. And that instability is just contagious. Renters feel it as mysterious rent hikes. Buyers feel it as deals that no longer pencil, right? And homeowners feel it as anxiety they can't actually name or put their finger on. Because every 90 seconds, the system adjusts and households absorb. And this is why the phrase housing is strong is kind of propaganda. Strong markets don't rely on hidden cost transfers. Strong systems don't collapse through paperwork. And what's coming next isn't a headline crash. It's a participation collapse. People stop moving, they stop upgrading, they stop buying, and mobility dies. And when mobility dies, the American housing promise, it goes along with it. This is also why builders are super nervous. I mean, they can offer 4% rates, they can buy down mortgages, they can throw in incentives, but they can't control the insurance companies. And that's the crack spreading behind the scene right now, because the builders aren't the only ones panicking. Banks are watching, and they're watching the coverage gaps. Municipalities are watching tax base wobbles, and investors are watching margins compress. This wasn't the collapse, it was the rehearsal. Because the real question isn't whether homes are overpriced, it's whether the system can still carry the homes it already sold. All right, guys, what do you think? Do I have this all right? Do I have it all wrong? Please put in the comment section below. I look forward to reading and replying to all of your guys' comments. And thank you again so much for watching me here on The Baseline. All right, cheers, everybody.